So this week I want to talk to you about share reclassification and how a share reclassification can be a really good structure to put in place if you're looking at maybe bringing family members into the business, you may be looking at bringing in investment, or you may be looking at retaining key members of staff. Now, a share reclassification in a nutshell is renaming or recategorising existing shares. So for example, you may have two shareholders, both with ordinary shares of £1 each. Now, by the Articles of Association, these shares will have the same dividend and voting rights. So if you pay one shareholder a £1,000 dividend, you've got to pay exactly the same dividend to the other shareholder. What a share reclassification does, for example, is you could split two ordinary shares into one A share and one ordinary B share. They can have the same voting rights, they've still got the same level of control over the business, but they can have different dividend rights. So for example, if one director wants to put money in a pension scheme and not take dividend, it gives you the flexibility to do that. You can also introduce schemes for employees such as growth shares, which could protect the value of the business that you've built up to date, but gives the employees skin in the game to the future value of the capital that's built up. So why share reclassification can be a really useful tool for tax planning and for future succession of the business, as well as retaining key employees. It's really important that you get professional advice, because done incorrectly, it can bite you on the bum further down the line, and also there can be hidden tax consequences that you might not be aware of, but it can be a really useful structure for you and your business. I hope you find the blog article useful, and get in touch as ever if you need any help.